MultiGreen, building attainable, sustainable, and tech-enabled multifamily real estate through impact investing.
Welcome to the MultiGreen podcast. I'm your host, Randy Norton, and today we'll be speaking with John Burns, the founder of John Burns Real Estate Consulting. He leads a team of professionals that he calls PALS, which is an acronym for passionate, articulate, likable, and smart. His PALs are located in offices all over the country where they provide subscribers with research and consulting. John Burns advises his clients on shifts in housing demand, supply, and affordability, as well as consumer, building products, and design trends. Enjoy our conversation. John, thank you for being on the podcast today.
Oh, you're welcome, Randy.
My hope is at the end of this podcast, I can be one of your pals. I understand that your associates in the office are called pals because they're passionate, articulate, likable, and smart people.
Oh, that means you're going to have to come work for me, though. You understand that?
Well, being in Irvine is not a bad place to work.
No.
So you're now in Irvine. Let's talk about that. In one of your most recent webinars that we subscribed to, there was a very interesting quote that I wanted to share with our listeners. It's by the 1976 Nobel Prize winning economist, Milton Friedman. He said, "Inflation is taxation without legislation."
Well, I find, frankly, we haven't really had serious inflation since I was in college. So most of my clients haven't dealt with this before. And so I just wanted to get their attention because there's so much confusion. And actually, as I've been studying Milton Friedman, he said, it always results in inflation was what he was implying, all this money supply. And that is not necessarily the case, but it is this time.
Well, I was studying money supply in school, and I was recently coming across the China money supply and the credit bubble there, potentially. And I'm just looking at our money supply. It's pretty significant.
Oh, a 25% increase in 2020, and then another 15% last year? Yes, I would agree. It is playing a huge role in the market, and we've never seen this before.
So in the last 2 years, we've had $5.5 trillion in stimulus put into the market. How is that affecting real estate?
Well, I think John Gray from Blackstone said it best. In his 30-year career, he's never seen the fundamentals this strong. But what he also pointed out was that Blackstone raised $155 billion to go into real estate. And it's all because of inflation. And this isn't just what you just alluded to. So we had the CEO of Brookfield, Bruce Flatt, at our client conference at the end of 2019, pre-COVID. And he said that income-producing asset is going to be the best investment, bar none, over the next several years, simply because people are looking for yield. And there was some concern about inflation at the time. And clearly, when you pile in a lot of inflation on top of a desire for yield, and it's all flows into real estate. And that's what we're seeing.
Phenomenal. I remember as a kid that I could get gas for 50, 60 cents. And I remember every once in a while driving by McDonald's by my high school saying that they were hiring. But I've never driven by a Burger King where they are giving away a $1,500 signing bonus.
I actually worked at a gas station the year that it crossed $1, and I had to tape the little one in front of the meter because it didn't have that extra digit. So yeah, that was my experience with inflation. But yeah, at every level, this seems to be crazy labor shortage, which is really such a dichotomy when we can't find the labor and we're beloaning the lack of adults. But at the same time, we're seeing all this household formation and housing demand. Where's the disconnect? Are we out of people, or are we surging in people? And that's one of the big areas of confusion right now.
So real estate, is it about location, or is it about demographics, or is it really about inflation?
Well, we wrote a book on demographics in 2016. So I think demographics tells you a very good long-term story. It doesn't tell you a story on 2022, but it's pretty predictable. I'm going to be a year older next year. So, it tells a good story. Real estate is all about location. What did flip during COVID, though, is that a lot of more affluent people got the permission slip to work from anywhere, maybe hybrid, maybe full-time. And it's actually been the big affordability solution that's allowed people to get more for their money in housing. And that is one thing that is different this time is it's a lot of, my employees have been moving all over. I had one employee move to New Zealand, one moved to England, others relocate all around America. They're all still with us and kicking butt. So location, but you get to pick it this time.
Well, you have some great products, some great team members. I love the posts that you have on LinkedIn. I follow you, and it's very insightful and actionable. So kudos to you and your team.
Well, thanks.
And I'm sure they're contributing from all around the world. With all of this inflation going on, now it gets a little complicated in the debt markets and the capital markets. Is the debt, the fixed income, is the 30-year fixed conforming mortgage, these rates, are they going to now spike?
The Fed is controlling those too, because in 2008, they started buying mortgage-backed securities, which brings the interest rates down. And now they own something like 24% of all the mortgages in the country. So all the headlines are about the Fed funds rate. But from a home ownership standpoint, you should be more focused on how much of mortgage-backed securities the Fed is holding. They tried to pare down their holdings in 2018. You saw rates run up. You saw sales slow when that happened, and then they've ramped it right back up again. So the Fed is controlling the long end of the curve, in my opinion. I know some people in the bond market that don't completely agree with that, but that's what I see.
Did I see a stat recently that the Feds now own something like 25% of all mortgages in the United States?
Yeah, that's where we calculated 24. Can you believe that?
How is that possible?
Because you and I go get a mortgage, and then they sell them onto Wall Street, and then the Fed is one of the buyers in those mortgage-backed securities, which the more buyers you have of those mortgage-backed securities, the more that keeps the rates down.
So as long as we keep these rates down, as long as people are buying these securities, foreign direct investment, is real estate here in the U.S. going to be okay and be stable here for the near future?
Well, I think low rates props up home prices. So the rates have been low for some time, and you've seen back-to-back years of close to 20% price appreciation. I don't think anybody was hoping we'd see that. I mean, that can cause problems. It already has. So even if rates went to 5% or something, the payments would really just skyrocket.
So the short-term rates, if they go up, what about this yield curve concept? Speak to me as a layman. What does this mean, and at what point should we be worried or concerned?
Well, you've got a lot of smart clients. They might know this better than me, but the long-term view is not always the same as the short-term view. And when the long-term is saying, I'll take lower interest rates than I want in the short term, that tells you the short-term is probably going to be pretty bad and we're heading into a recession. So that's why people look at the quote-unquote yield curve. But what I just told you is the Fed is also playing games with the short end and the long end. I almost feel like the Fed is trying to control the yield curve, which we've never seen that before.
So if there's this yield curve that becomes inverted, what are the odds of recession?
Let's not go there, because there are a lot of your listeners that know more about that than I do. So.
Okay. Well, I'm bullish. I think you are too. Let's talk about the demand. I often hear, are we at the peak of the market? Is there going to be a recession? What about inflation? Let's go back to our friend Milton Friedman. And he says that inflation is always and everywhere a monetary phenomenon. What does that mean?
Well, that's a good question. What he was trying to say is that I think creating a lot of money supply creates inflation, but it doesn't create inflation if it just sits in the bank or sits in people's checking accounts. It creates inflation when a lot of people go spending it and creates a lot of volatility. And that's what the Fed is trying to figure out with that $5.5 trillion of stimulus. A lot of that ended up in the stock market. Assets went way up. People put it into cryptocurrency. That went way up. That technically is not inflation, because that doesn't meet any of the definitions, but it is inflation in people's net worth, and it makes people more confident, and people are borrowing against that. People are out spending. And this cycle, there was so much stimulus, it has created a ton of inflation. What I don't really understand, I never thought was possible, was that you would have 7% inflation and 2% 10-year treasuries. I mean, who is saying I'm okay with the value of my cash going down 5% per year? Apparently trillions of dollars are okay with that. If not, get into real estate income investing. And that's what people are doing.
Well, let's get out of the inflation topic for a minute and let's get into the real estate fundamentals. You mentioned that John Gray said in 30 years, he's never seen better real estate fundamentals in his career. The markets are not getting enough supply. There's not enough labor. There's not enough materials. The supply chain is broken in some regards. National home builders can't get garages installed to their homes. What do you make of all this chaos?
That's our job. I mean, it's a mess. I think consumers are handling the affordability better than you think because they're relocating to get more for their money. And we've studied the rent to income ratios. They really haven't climbed. We're studying the debt to income ratios, even in places like Austin, where prices have gone through the roof, but the debt to income ratios are still in pretty good shape there. And then people are sitting on their homes, not putting them on the market. So you've got very little resale supply. And then the home builders can't get it built, so they can't meet the demand and their costs are going through the roof. So they're pushing prices, crossing their fingers that the consumer will still be able to afford it. And so far they have. And that's the story we've got is really very little on the market for sale. And even though I think the demand is not as strong as it was a year ago, it's still more than demand than supply. So prices are continuing to rise. This movement of investors on top of it makes it even a bigger demand supply mismatch.
What a mismatch. I live in Las Vegas. I just flew in from Phoenix, and these single family rents are skyrocketing year over year. I think they were the top two markets from a single family rent index. Is this a phenomenon in the Southwest, or is this really what's happening nationwide?
That is a great question. So we've got that data. We've been tracking it since 2012. We kind of fell into this business by accident during the downturn. It's very, very different nationally. So we're seeing some 20% rent increases throughout the South, but we roll up the whole country, and the whole country is only at 5%, because there's a lot of homes in the Midwest that are growing at like 4%. So it's a very, very different story by market, but there's only 3 markets in the country their rents are down: Wichita, San Francisco, and I think San Jose is the other one. Everywhere else rents are up.
When you have such a low resale inventory, when you have such low inventory coming online with new home builds, and you have prices, whether it's rents increasing or home prices increasing, what does that do to just the real estate market and price appreciation and this demand and supply curve? Is it sustainable?
No, it's not sustainable. I mean, unless people are going to start getting raises at the same rate. Now, and you led with that with Burger King. I mean, truck drivers, construction workers, I think their incomes are up way more than 20%. So there are sectors that are handling this just fine. There's other sectors that haven't seen their wages move at all. I guess today we just found out Major League Baseball, they're getting a raise too. So every group is a little bit different.
So in Las Vegas, I think it was 8.5% or 8.8% that employment grew. And if you remember during the COVID-19, everyone thought that Las Vegas was dead and it would never come back. And I didn't agree with that. But now here we are, and Las Vegas is leading with employment growth. Is that because Californians are leaving California and, for example, 5 people an hour are moving into Clark County? Is this absolute, or is this a relative percentage?
I hadn't heard the 5 an hour before. It's probably been 4 for the last 20 years, though. There's been such strong growth in Clark County. Well, what's happening right now with the snapshot is the last sector of the economy to recover is leisure and hospitality. So it is Las Vegas and it is Orlando. And actually, San Francisco and New York have a lot of leisure and hospitality employment too. Those are the strongest sectors right now. There are other economies like Austin that aren't growing as quickly as that, but they've got all their jobs back and then more. So that 8.8% is a snapshot of today because leisure and hospitality is finally getting their act back together.
Let's continue with this population trend of migration or in-migration population growth, which leads then to household formation. I'm looking at a map of the United States, and it just seems like the western, southwestern, and actually the southeastern United States too, is growing disproportionately. What's to credit that?
There's a lot of reasons. So when we wrote the book in 2016, 46% of America lived in the South, but 62% of the growth was going to the South. So this has been going on forever. It's affordable. Those economies their governors are out recruiting employment. I think in California, our governors are saying, would you please leave? New York and New Jersey, the same. And those are the primary reasons. And there's some tax reasons and other things too. And then also there's demographics. People tend to retire in the South where it's warmer. So you're seeing a lot of demographic driven reasons.
Okay, so let's talk about demographics for a minute and the U.S. population. Historically, we've needed, I don't know how many millions per year in new built homes and inventory. I've seen studies suggesting that we're short anywhere between 5.4 million and 6.8 million units. Can you peel back that onion a little bit and give us a little bit more context?
Yeah, well, it's really simple. Those studies are wrong. They made two mistakes. One, they just looked at the history and assumed we had never overbuilt, but we massively overbuilt from 2000 to 2010. In fact, I think the number of vacant homes grew by 3 million during that period. But that analysis says, well, that must be the norm. And then the other thing is that they're ignoring the 20-year trend of our adult population growth is not growing as fast as it used to. And the big thing I think people are missing on that is when the baby boomers were coming of age, we were adding 4 million people into the workforce and less than 2 million people were passing away. Now the numbers are getting closer to the same. You may be adding 4.3 million people to the workforce per year and maybe 3.8 or 3.9 passing away. That's not as much growth. And we pointed out, our book was called Big Shifts Ahead. We pointed that out a lot. We projected that. Our projection turned out to be a bullseye over the next 5 years over how much housing we needed. Now it's surging beyond our projection, which I think is driven by some of this inflation stuff. Our number right now, in 2016, we were overbuilt. Our number right now is that we think we're underbuilt by about 1.7 million. Still significant, but that assumes at normal affordability levels. And I don't think we have normal affordability levels because those 1.7 million people can't all afford to form their own household right now. So that's our view on it.
When you have 1.7 million homes that are needed, what does that do to the price of homes and the price of rent? And what is that new affordability definition?
When you aren't supplying enough to meet demand, prices go through the roof. And that is part of what's happened. And that's part of the equation. So when people say 5 or 6 million undersupplied, or when I say 1.7, that gives people a lot of comfort. They're like, oh, housing can't correct because we've got this huge undersupply. But the prices and rents have already adjusted for much of that. And I don't think that's a fair conclusion that a lot of people make. Prices and rents could correct tomorrow if we have a recession. Just nobody's forecasting a recession.
How long will it take to bring this 1.7 million unit shortfall back to equilibrium?
But just coincidentally, there's 1.7 million homes under construction right now. Obviously very empty, about 900 and something thousand single family, 800,000 multifamily, which by the way is an all-time high. They're taking forever to get finished. So sometime over the next 9 to 12 months, that will be those numbers will be met. There will be some new adult household formation going along with that. So I think it would take us at least a year, maybe two. But that being said, that doesn't mean bad things can't happen over the next year or two.
John, there's this idea that there's a shadow inventory and that there always has been one, and it's been very hard to predict permitting, what's under construction, and what really is our shortage. Can you tell our listeners today maybe what that shadow supply might look like?
Homes under construction are vacant, so you can call that shadow supply if you want. There's some weird things going on too. With all this investor activity, I believe a lot of those investors are holding onto the house sitting there empty. There's been a surge in second home buying. On top of that, particularly in New York and San Francisco, but mostly New York, there was a decoupling of households where people didn't want to live with 2 or 3 roommates when COVID was being spread and their Wi-Fi was being sucked on by everybody. So more households formed. As rents are rising dramatically, I'm expecting some of those people to be forced to live together again. So I think there's a lot of supply that's going to be coming back to the market that is not available for you and I to move into right now. And I think that's the shadow supply. I haven't been able to figure out exactly that number yet. We're trying.
I've seen this movie before.
Yeah.
How does this end?
Well, this usually doesn't end very well, but it depends. And this is what I think the Fed is trying to do. So, as we sit here, the Fed hasn't done anything. They've said they're going to do stuff, but they're trying to gauge how the market is going to react because they don't want to push the economy into a big recession. My view is that the most significant recessions are usually some sort of financial crisis, which is normally involving over leverage and securitization on Wall Street. Last time it was subprime mortgages. That's my big concern, is that the longer this is going on, people are making high risk loans right now and securitizing them because that's the only way to get yield. There's probably a lot of garbage debt out there that's the principal's not going to get repaid. And I have no idea how big that is. And I talk to my friends in the bond market. That's the question I'm asking them all the time. Are you seeing a lot of this? And the answer is like, no. But then you know what? Oh, I know somebody who's lending against crypto balances. And I've got a client who's securitizing fix and flip loans. And you start hearing these stories over and over again. There's all these new companies now. We're starting at $10. You can invest in a portfolio of single family rental homes, levered. That's what I worry about, is how much leverage is out there. And I don't think it's in the federally regulated banks this time. It seems to be outside the system. So that's what keeps me up at night, is because I don't understand that. But I know some of it is going on.
Well, let me tell you what keeps me up at night. I'm looking at 4 or 5 key indicators over the last 10 or 20 years where there's an analysis done where there's housing, income, and inflation growth really since the beginning of 2000. And you look at inflation, it's been 55%. Incomes have increased by 64%. But inflation and incomes are not keeping up with apartment rents at 77%, or at home payments, they're up 88%. And single family rentals are up 91%. Isn't that the antithesis of the American dream?
I think you saw that chart in our webinar, because those are exactly our statistics. So, you're exactly right. Everything, and surprisingly, single family rents have grown the most over that time period, more than anything else. They never took a dip, and that's why.
Well, that market has been performing well. I have one last question for you. Do we have a housing crisis?
I mean, that's a very individual decision. There's a lot of people out there who cannot afford quality housing. So all those people would conclude, and everyone who cares about them, that we have a housing crisis for them. For a lot of the people that are renting these homes, and for almost all of my clients, those people are able to afford the rent. People are able to afford buying a home. Obviously, with all this demand, they don't see it as a crisis. And, there is a location element to this too. Everybody in New York and San Francisco, you can't bring more housing, although I guess they're talking about making Manhattan bigger by filling in the water. There's a location issue. So yes, if you want an affordable home in Manhattan, it's a crisis, but you know what? You can move to Kansas City if you want, where you can buy what you want. And so that's my long-winded answer to that. It's not a yes or no. It kind of depends on your perspective.
John, at the beginning of the podcast, I told you that I would give you the chance to define attainability. What does attainability mean to you?
I mean, attainability means I can afford it and continue to live and support my family. So for people on minimum wage, that's one story. For people that make a lot of money, that's another story. And you can go to the locations where you can buy the land and build it for the local people can afford. That's attainable.
John, it was so great being with you today on this podcast. I hope that we can do it again in the future and recheck in on the real estate economy here in the United States.
Okay. Thanks, Randy.
Thank you.
Thank you for listening. Join us as we build 40,000 attainable, sustainable, and tech-enabled multifamily homes by 2030. And if you like the content you're hearing, hit the subscribe button. Follow us at Think MultiGreen and sign up to learn more at www.multi.green.